Everyone tells you to max out your 401k hay before investing in dividend stocks. But what if I told you that conventional wisdom is completely backwards? I just finished a comprehensive analysis comparing both strategies over 20 years, and the results are going to flip everything you thought you knew about building wealth. The winner isn't what the financial advisors want you to believe, and by the end of this video, you'll understand exactly why one path can make you significantly wealthier than the other. Meet Sarah, a 28-year-old marketing manager making $65,000 a year. She's been following all the traditional advice, maxing out her 401k, getting that company match, investing in those boring index funds everyone raves about. Meanwhile, her coworker Jake took a completely different approach. He contributes just enough to his 401k to get the match, then puts every extra dollar into dividend-paying stocks. After 5 years, guess who's ahead? The answer will shock you, but more importantly, it reveals a fundamental flaw in how we think about retirement planning. The financial establishment has convinced millions of people that tax-deferred growth is the holy grail of investing. They paint this picture of compound interest working its magic in your 401k while you sleep. But what they don't tell you is the hidden costs, the restrictions, and the massive tax bomb waiting for you at retirement. If you want to understand exactly how to build wealth the smart way and avoid the traps that keep most people broke in retirement, subscribe right now. I break down these wealth-building strategies every Tuesday and Friday, showing you the real numbers behind financial independence that nobody else wants to talk about. Here's what most people don't realize about 401k plans. They're not actually designed to make you wealthy. They're designed to make Wall Street wealthy while giving you just enough to survive retirement. Think about it. You put money in today, get a small tax deduction, then pay taxes on everything when you withdraw it. But here's the kicker. You're paying taxes on both your contributions and all the growth at your ordinary income tax rate, which could be 30% or higher by the time you retire. But before I reveal the specific numbers that prove why dividend investing crushes 401k plans for building real wealth, let me share something that's going to completely change how you think about the tax advantages everyone talks about. There's a hidden mathematical reality about tax brackets and retirement income that financial advisors pray you never discover. Let's start with the basics that everyone thinks they understand. The 401k gives you an immediate tax deduction. Put in $22,000 this year, save about $6,000 in taxes if you're in the 28% bracket. Sounds great, right? The money grows tax-deferred for decades, compound interest works its magic, and you end up with a massive nest egg. This is the story they sell you. But let's run the real numbers with Sarah's situation. She maxes out her 401k at $22,500 per year. Her company matches 50% up to 6% of her salary, so she gets another $1,950 in free money. Total annual contribution? $24,450. Over 20 years, assuming a 7% annual return, she accumulates about $1,200,000. Now here's where it gets interesting. When Sarah retires and starts withdrawing that money, she pays ordinary income taxes on every dollar. If she needs $50,000 per year to live on and she's in a 22% tax bracket, she actually needs to withdraw about $64,000 from her 401k to net $50,000 after taxes. That $1,200,000? It's really only worth about $940,000 in today's purchasing power. But Jake took a different approach. Instead of maxing out his 401k, he contributed just enough to get the full company match, $3,900 per year, getting that same $1,950 match. Then he took the remaining $18,600 he would have put in his 401k and invested it in dividend stocks. Jake focused on companies like Coca-Cola, which has increased its dividend for 61 consecutive years. Johnson & Johnson, dividend king with 59 years of increases. Realty Income, the monthly dividend company that's raised its dividend for 94 consecutive quarters. These aren't speculative growth stocks. These are established, profitable companies that pay you to own them. Here's where the magic happens. Jake's dividend portfolio started yielding about 3% in year one. So his $600 annual investment generated about $558 in dividends the first year. But here's the beautiful part. Those dividends are taxed at the qualified dividend rate, which is 0% for most middle-class investors, 15% for higher earners. Compare that to the ordinary income tax rate Sarah will pay on her 401k withdrawals. But it gets even better. While Sarah's 401k just sits there growing silently, Jake's dividend stocks are actively working for him. In year 2, his portfolio balance is now $37,200, generating about $1,100 in dividends. He reinvests those dividends, buying more shares, which generate more dividends. This is the real compound interest that financial advisors don't want you to understand. By year 5, Jake's dividend portfolio is generating over $3,000 annually in passive income. By year 10, he's receiving over $8,000 per year in dividends. These aren't withdrawals that deplete his principal. This is income his stocks pay him for being an owner. And remember, most of these dividends are taxed at 0% or 15%, not the 22% to 37% rates that Sarah will pay on her 401k withdrawals. Let's fast forward 20 years and see who really won. Sarah has her $1,200,000 of 401k, but she can't touch it without penalties until age 59 and a half. When she does withdraw, every dollar is taxed as ordinary income. Jake has built a dividend portfolio worth about $900,000, but here's the game changer. It's generating over $36,000 per year in dividend income, most of it taxed at favorable rates or not at all. But the real advantage isn't just the tax treatment. It's the flexibility and control. Sarah's money is locked up in her 401k. She can't access it for emergencies, opportunities, or life changes without paying heavy penalties. Jake's dividend stocks are liquid. He can sell them anytime, access his money for opportunities, or simply live off the dividend income without touching the principal. Think about this scenario. Both Sarah and Jake lose their jobs during an economic downturn. Sarah has a massive 401k balance, but accessing it means paying a 10% penalty plus ordinary income taxes. If she withdraws $50,000 for living expenses, she'll pay about $5,000 in penalties plus $11,000 in taxes, netting only $34,000. Jake simply continues collecting his dividend checks. No penalties, favorable tax treatment, and his principal remains intact. Here's another advantage that most people never consider: estate planning. When Sarah dies, her 401k becomes a tax nightmare for her heirs. They'll pay ordinary income taxes on every dollar they withdraw, potentially pushing them into higher tax brackets. Jake's dividend stocks get a stepped-up basis when he dies, meaning his heirs inherit them with the tax basis reset to current market value. They can sell immediately with no capital gains taxes, or keep collecting those dividends tax efficiently. Now, I know what you're thinking. What about that company match? Isn't that free money you're giving up? Absolutely not. Both Jake and Sarah got the full company match by contributing enough to trigger it. The question isn't whether to get the match. You always get the match. The question is what to do with every dollar beyond that match. The 401k industry wants you to believe that tax deferral is always better than paying taxes today. But this ignores a critical reality. Tax rates are historically low right now, and they're probably going higher. When you defer taxes to retirement, you're betting that tax rates will be lower in 20 or 30 years. Given the massive government debt and spending commitments, that's probably a losing bet. Let's also talk about the hidden fees that are destroying 401k returns. The average 401k plan charges about 1% per year in fees. That might not sound like much, but over 20 years, it's absolutely devastating. On a $500,000 balance, you're paying $5,000 per year in fees. Over 20 years, those fees compound to over $200,000 in lost wealth. Jake's dividend stocks. He can buy them through any discount broker for less than $10 per trade. Once he owns Coca-Cola or Johnson & Johnson, there are no ongoing management fees eating into his returns. The companies pay him dividends directly, and he keeps every penny after taxes. But here's where this gets really interesting, and it's something that's going to completely change how you think about this debate. We've been assuming that both strategies deliver the same gross returns. 7% per year. But what if I told you that high-quality dividend stocks have actually outperformed the broad market over long time periods, especially when you factor in reinvested dividends? The S&P 500 Dividend Aristocrats, companies that have raised their dividends for 25 consecutive years or more, have delivered an average annual return of 10.4% over the past 20 years, compared to 9.8% for the broader S&P 500. These aren't risky growth stocks or speculative investments. These are the most stable, profitable companies in America, and they've consistently outperformed while paying you to own them. Here's why this outperformance makes sense. Companies that consistently raise dividends for decades are demonstrating several key characteristics. First, they're generating consistent cash flow. You can't pay and raise dividends without real profits. Second, they're disciplined capital allocators. They're not wasting money on empire-building acquisitions or speculative ventures. Third, they're shareholder-focused. Management teams that prioritize dividend payments are working for shareholders, not just themselves. But there's another factor that most investors completely miss: the behavioral advantage of dividend investing. When you own stocks that pay you every quarter, you develop a completely different relationship with market volatility. When Jake's portfolio drops 20% in a market crash, he's not panicking because his dividend payments actually increase. Companies like Coca-Cola, Procter and Gamble, and Microsoft keep paying those dividends regardless of what the stock price does day to day. This behavioral stability leads to better long-term results. While 401k investors panic during market downturns and make emotional decisions like switching to conservative allocations at exactly the wrong time, dividend investors stay calm and keep collecting their payments. They often increase their positions during market crashes, buying more shares of quality companies at discounted prices. Let's run a specific example with real numbers. During the 2008 financial crisis, Coca-Cola's stock price dropped from about $60 to $40, a 33% decline. But the company maintained its dividend payment of $1.44 per share annually. An investor who bought more shares at $40 was getting a 3.6% dividend yield, compared to the 2.4% yield they would have gotten at $60. When the stock price recovered over the next few years, those additional shares purchased during the crisis provided both dividend income and capital appreciation. Compare this to the typical 401k investor experience during 2008. Most people watched their balances get cut in half and either panicked into conservative allocations or stopped contributing altogether. They missed the entire recovery because they were focused on account balances instead of income generation. There's also the psychological benefit of regular dividend payments. Every quarter, Jake receives actual cash payments from his stocks. This creates a tangible connection to his investments and reinforces the wealth-building process. Sarah's 401k just shows a number on a statement that goes up and down with market volatility. Which approach do you think creates more confidence and long-term commitment? Now let's address the elephant in the room. What about market crashes? Don't dividend stocks crash, too? Absolutely they do. But here's the difference. The income stream from quality dividend stocks is much more stable than stock prices. During the 2008 crisis, 91% of dividend aristocrats maintained or increased their dividends. Even in 2009, at the height of the crisis, 86% of these companies maintained their dividend payments. This stability matters because it changes your investment timeline. Sarah's 401k success depends entirely on selling her investments at the right time, hopefully when markets are high. If she retires during a market crash, she could be forced to sell at low prices, permanently damaging her retirement security. Jake's dividend portfolio provides income regardless of market conditions. Even if his stock prices are temporarily depressed, the dividend payments continue flowing. Here's another critical advantage that financial advisors never mention: inflation protection. High-quality dividend stocks are often the best hedge against inflation because the underlying companies can raise their prices and maintain profitability. When inflation pushes up the cost of everything, companies like Coca-Cola simply raise the price of their products. This translates into higher profits and higher dividend payments for shareholders. 401k balances, on the other hand, are devastated by inflation. The purchasing power of that fixed account balance erodes every year. Sarah's $1,200,000 401k might sound impressive today, but if inflation averages 3% over the next 20 years, it will have the purchasing power of about $660,000 in today's money. Jake's dividend portfolio provides built-in inflation protection. As companies raise their dividends to keep pace with inflation, his income stream grows automatically. Those $36,000 in annual dividends he's receiving in year 20 might be $60,000 or more if inflation drives dividend growth higher. Let's also consider the international perspective. Many of the world's most successful investors focus heavily on dividend-paying stocks. Warren Buffett's Berkshire Hathaway portfolio is loaded with dividend champions like Coca-Cola, American Express, and Apple. These aren't accidents. Buffett understands that owning pieces of profitable businesses that pay you to hold them is the most reliable path to long-term wealth. In countries with more mature pension systems, dividend investing is often the foundation of retirement planning. The United Kingdom has a strong culture of dividend investing, with many retirees living comfortably off dividend income from FTSE 100 companies. These investors understand something that American workers are just beginning to discover. Ownership of productive assets beats reliance on government or corporate pension promises. But here's where this story takes an unexpected turn that changes everything we've discussed so far. Remember Sarah and Jake from our example? I told you Jake was ahead after 5 years, but I haven't shown you the most shocking part of their comparison. What if I told you that Jake isn't just ahead? He's so far ahead that Sarah can never catch up, even if she gets better returns from now on. After 20 years, Jake has built something that Sarah's 401k can never provide: true financial independence. His dividend portfolio generates enough passive income to cover his basic living expenses. He doesn't need to work anymore because his investments work for him. Sarah, despite having a larger account balance, still needs to work because accessing her 401k means penalties and massive tax bills. This is the real difference between building wealth and building account balances. Wealth is about cash flow and control. Account balances are just numbers on a screen that you can't actually use without consequences. Jake owns productive assets that pay him to hold them. Sarah owns shares of mutual funds that she can't access without penalties and taxes. The financial industry has convinced millions of Americans that bigger account balances equal more security, but this is backwards thinking. Security comes from predictable cash flow that doesn't depend on market timing, withdrawal rates, or government policy changes. Dividend-paying stocks provide that security because they're backed by actual business profits, not market sentiment or political promises. Here's the final piece that ties everything together: scalability. As Jake's career progresses and his income grows, he can accelerate his dividend portfolio growth dramatically. Every raise, every bonus, every side income can be immediately deployed into dividend-paying stocks. There are no contribution limits like 401k plans. If Jake gets a $10,000 bonus, he can invest all of it immediately in dividend stocks. Sarah, meanwhile, is capped at $22,500 per year in 401k contributions, plus catch-up contributions after age 50. Even if her income doubles, she can't accelerate her 401k wealth building beyond these government-imposed limits. This means high earners are actually penalized by the 401k system. The more successful they become, the less they can use this supposedly superior strategy. The math is clear, the flexibility is obvious, and the tax advantages are compelling. Dividend investing provides better after-tax returns, more flexibility, superior inflation protection, and true financial independence. The 401k industry has spent decades convincing Americans that tax deferral and account balance growth are the keys to retirement success, but they're wrong. The real path to financial independence is building a portfolio of quality dividend-paying stocks that generate enough passive income to cover your living expenses. This isn't about speculation or market timing. It's about owning pieces of profitable businesses that pay you to be an owner. If you're ready to start building real wealth instead of just accumulating account balances, you need to understand the specific strategies that make dividend investing so powerful. Check out my video, The $1,000 Dividend Strategy Nobody Talks About, right here. It reveals the exact approach I use to build dividend portfolios that generate consistent passive income, starting with just $1,000. You can find it there on your screen. The strategies in that video will show you exactly how to implement everything we've discussed today and start building your own dividend income stream immediately. The 401k versus dividend stocks debate is over, and now you know exactly why dividend investing wins.